The end goal of many dividend investors is to generate sufficient passive income to cover their living expenses. There are really two ways to get there faster. You can either have a larger investment portfolio, or you can generate more passive income from the portfolio that you already have. In today's video, we're going to explore the second strategy. More specifically, I'm going to share with you a sophisticated option strategy that you can use to generate more passive income called the cash secured puts option strategy. The cash secured puts option strategy is fairly complex, and I want to make sure to answer all of your questions. Accordingly, this is going to be a fairly comprehensive video. Here's what we'll be talking about today. What is a cash secured put option strategy? How to select which cash secured puts to sell, and then 3 examples of cash secured put option strategies using blue chip stocks, Johnson & Johnson, the Coca-Cola company, and Berkshire Hathaway's Class B shares. To understand how to effectively implement a cash secured puts option strategy, you need to have a thorough understanding of what a stock option actually is. Here's the formal definition of stock options. A stock option is a contract between two parties in which the stock option buyer purchases the right, but not the obligation, to buy or sell 100 shares of an underlying stock at a predetermined price called the strike price from or to the option seller within a fixed period of time. If the contract allows the option holder to buy the security, it's called a call option. Conversely, if the contract allows the option holder to sell the security, that's called a put option, which is the topic of today's video. One important thing to keep in mind is that each stock option corresponds to 100 shares of the underlying security. If you're not aware of that, you could dangerously play with stock options that correspond to more capital than you actually have to invest. Keep that in mind as we progress through the rest of this video. In a cash secured put option strategy, you're selling someone else the right to sell you their stock at a predetermined price. The trick to successfully implementing this strategy is choosing a price that you would be happy to buy the stock at, regardless of whether it was through a stock option or otherwise. The benefit to using a cash secured put option strategy is that you receive the option premium upfront, which allows you to generate passive income from the cash that's sitting in your investment account, waiting to buy shares of a high quality business at a price that you deem fair. An image is helpful in understanding the payoff profile of a cash secured put option strategy. In this graph, the underlying stock price is on the horizontal axis, and the strategy's payoff profile is on the vertical axis. As you can see, the upside of the strategy is capped to the option premium received less any applicable commissions. As the price of the underlying stock declines past the strike price of the option, the strategy becomes less profitable and, eventually, the investor participating in the cash secured put option strategy will lose money. In the ideal scenario, the stock that you're writing cash secured puts against will trade above the strike price of the options that you sold for the entire lifespan of the option. This means that you'll be able to receive the premium upfront, generate passive income, and never be forced to buy the security. With that said, there are still 2 other scenarios that may occur that you need to understand before implementing this strategy. The first is if the underlying stock falls to a price that's between the strike price of the option and the strike price minus the option premium that you received at the beginning of the strategy. In this scenario, your adjusted cost basis, adjusted for the option premium that you received at the beginning, will still be better than the prices available on the open market, and you'll still win using this strategy. The third scenario is the only scenario in which the cash secured put investor will lose money. In this scenario, the stock price will fall beneath the strike price minus the option premium that you received at the beginning of the strategy. What this effectively means is that you'll be forced to buy the stock at a price that's higher than prevailing market prices, which means that you'll lose because you'll immediately have a position that's trading at an unrealized loss. With that said, these differences are usually minor, and as long as you're buying high quality businesses, they should correct themselves over time. To summarize this section, a cash secured put option strategy allows you to receive cash upfront in exchange for the obligation to buy a stock if it declines below a certain price. This is a great way to generate passive income from the dry powder that's sitting in your account waiting to buy high quality businesses. In the next section of this video, I'm going to describe to you how to find out which put options you should sell in order to effectively run a cash secured put option strategy. The science and strategy of determining what cash secured puts to sell is well beyond the scope of this video. It's an aspect of the financial markets that can be endlessly optimized by quantitative investors. If you're anything like me, you just want a strategy that is simple and repeatable, that you can do over and over again to generate more passive income from your investment portfolio. And that's exactly what I'm going to share with you today. In my experience, an excellent way to identify put options that are suitable for a cash-secured put strategy is by targeting put options with the following characteristics. Stock options with between 45 and 60 days until expiration, and that have strike prices that are approximately 1 standard deviation below the stock's current market price. To help you better understand how to implement this strategy, I'm going to show you 3 examples using blue chip stocks. The first example is healthcare conglomerate Johnson & Johnson. When you look up stock options in your broker's trading interface, you will usually be presented with what's called an options chain. An options chain shows the different strike prices for call and put options at a certain expiration date. For example, here's the options chain for Johnson & Johnson using options that expire on July 27, 2018, using the trading interface from Interactive Brokers. You can see Johnson & Johnson's ticker in the top left. Nearby, you can see that I have selected the July 27, 2018 expiration date. With this broker, hovering over particular strike prices will show you the standard deviation difference between the security's current price and its market price. In Johnson & Johnson's case, the $116 call options are exactly 1 standard deviation below its current price, making them a prime candidate for a cash-secured puts option strategy. We've now determined which put options are suitable to sell for Johnson & Johnson. The next step is determining how much cash must be put up by you, the investor, as collateral for the options trade. What this means is that you essentially have to set aside this cash in the event that Johnson & Johnson stock actually declines below the strike price of the options that you're selling. The way you calculate this is by multiplying 100 by the strike price of the options you've sold, which in this case are $116. Doing this math tells you that you need to set aside $11,600 as cash to potentially buy Johnson & Johnson before or on the expiration date of the option. After determining the necessary collateral, the next step is to determine how much we should actually sell the stock options for. Now, there are certain nuances when it comes to buying and selling options that you really don't see when you're buying and selling equities, and they deserve some explanation here. The first is the relative illiquidity of stock options. As you can see by examining Johnson & Johnson's options chain, there is a real bid-ask spread for each of the strike prices in the options chain. As an options seller, which is what you're doing in a cash-secured put strategy, you should always budget to receive the bid price. The second unique aspect to buying and selling stock options is that even though each options contract corresponds to 100 shares of stock, their prices are actually quoted on a per-share basis. Accordingly, you need to multiply the price that you're quoted by 100 to see how much you'll actually pay up when you buy or sell an option. In the case of Johnson & Johnson, we see that the put options are quoted at 79 cents per share, which means that you'll actually gain $79 when you sell a 100-share contract. Lastly, we'll want to calculate the yield that we'll get on the cash that we've set aside for this cash-secured puts trade. The math behind this is relatively simple and is shown in the following formula. The formula has 2 factors. The first is option premium divided by the trade's cash collateral. This factor shows you how much absolute return you received expressed as a percentage of the cash collateral. The second is 365 divided by the stock options days until expiration. This transforms your absolute return into an annualized return figure. This is important because almost all rates of return in finance are expressed on an annualized basis, so this improves the comparability of the cash-secured put option strategy. In the case of Johnson & Johnson, here's what the math actually works out to. The investor receives $79 of option premium in exchange for posting collateral of $11,600. The stock option had 45 days until expiration. This provided an annualized return of 5.5%. Next up, I'm going to provide similar tutorials for Coca-Cola and Berkshire Hathaway's Class B shares. I'm going to skip some of the nitty-gritty details that we went through in this first example, but I encourage you to continue watching through the rest of this video to really cement the fundamentals of the cash-secured put option strategy. Next up is Coca-Cola. You can see the company's options chain here. As before, the company's ticker is shown in the top left and the expiration date of the options we're looking at is shown just below that. In this case, the $42 strike price is just over 1 standard deviation below Coca-Cola's current market value. These options have a bid of 22 cents per share or $22 per option contract. Here's how we can calculate the additional yield on the cash that we're going to set aside to eventually buy Coca-Cola shares. The $42 options dated July 27th are selling for $22 per contract. $4,200 of collateral would need to be posted to secure this trade. This cash-secured put provides an annualized yield of 4.2%. The next example of a cash-secured put strategy that we're going to explore is for Berkshire Hathaway's Class B shares. Before we go into the example, I want to point something out. This is an excellent example of how you can use cash secured puts to generate passive income from a potential investment in a company that doesn't actually pay a dividend. Because of this, Berkshire Hathaway is an example of how you can use stock options to generate synthetic passive income from stocks that don't pay dividends. As before, we'll first consider Berkshire Hathaway's options chain. You can see the company's options chain for July 27th here. In this case, it turns out that Berkshire Hathaway's $185 put options are one standard deviation below its current market price. You'll note that the options are selling for 91 cents per share right now, or $91 per contract. Here's how we'll calculate the yield available from this cash secured put opportunity. The $185 options dated July 27th are selling for $91 per contract. $18,500 of collateral would need to be posted to secure this trade. The cash secured put provides an annualized yield of 4%. In this video, we went into the details of how to implement a cash secured put option strategy. We also discussed the relative pros and cons of this sophisticated investment technique. If you take anything away from this video, let it be this. The cash secured put option strategy allows you to collect option premium upfront in exchange for the obligation to potentially buy a stock at a certain price at some point in the future. Because of this, you should only implement this strategy on stocks that you'd be happy to buy for the long term. Thanks for watching this tutorial on cash secured puts. We invite you to like this video and subscribe to our channel so that you can stay in touch with the latest investing content from Dividend.